So I know we also discussed during the week some top tax tips. I can't say it. Top tax tips for landlords. So specifically, John's agreed to just give us some 5 key points that landlords need to know about tax relating to rental properties. But also some of the common mistakes that people make, which I think is super helpful for especially any new landlords, because a tax return is a fairly straightforward process if you get everything right. But as you said previously, it's when you make mistakes that it starts to become complicated to put them right.
Yes.
So let's hope that we can stop some people making some mistakes at the start.
Yeah.
So fire away.
So my first tip is to get your ownership of the property right.
Okay.
So particularly when you're purchasing a new property, look at who you want the money to go to.
Right.
For example, this happens a lot. People, when you buy a property in joint names, specifically husband and wife,
yeah,
HMRC will treat the ownership as 50-50, no matter who's put the money in, no matter what's done. If you don't tell them otherwise, it's a 50-50 ownership.
Okay.
Now, if you've got, I'm not going to be sexist about this, so if you've got the wife
yes,
in a 40% tax bracket,
yeah,
and the husband's in a 20% tax bracket,
yeah,
you want the husband earning more of the rental income than the wife.
okay. So because he's getting taxed
He's getting
at
taxed
the lower
at
rate.
a lower rate. So everything, if you split it 50-50, 50% of it's going to be taxed at 40% and 50% at 20%.
Yes.
If you put most of the property on the husband,
yes,
you pay much more tax at the 20% rate than at the 40% rate.
okay.
So you make sure you get your ownership set
Yeah.
to how you want it.
Okay.
The way to do that is by not as joint tenants,
Right.
but as tenants in common.
I've heard that expression, and I've always purchased obviously as joint tenants
And
with my husband.
most people do that.
Yeah.
So that's basically the standard way if you're buying a property as husband and wife.
So you'd speak to your solicitor, I guess, at
so
the start
it's
of
a
the
very
process.
easy thing, and you can actually change it. You can change it to tenants in common.
Oh, okay, so
afterwards.
maybe landlords who have got that 50-50 set up now and they're
Yeah.
listening to this thinking, I need to change it, they can still do it.
They can still do it, put it into tenants in common. And basically what that means is 50% is the wife's and 50% is the husband's. It's completely separate ownership.
Okay,
Whereas joint, the whole lot is owned jointly between
Right.
the two.
okay,
By doing that, you can decipher what split you want.
yeah,
Now, it's not necessarily an easy thing to change that if you've already got a 50-50 split for HMRC.
okay,
You can declare, I forget the form number, but there is a form you can fill in to HMRC to say, right, actually the split is 75%, it is 75%
yeah,
hers, 25% hers, sorry, otherwise you've got a big house. You can do that, but they ask for proof
yeah,
of why it's set up like that, and that gets a little bit complicated.
okay,
So the best thing to do is set it from the start.
yeah,
Speak to an accountant if you're not sure how to split it, because
Yeah.
they can work out the best method.
Yeah.
There are drawbacks.
okay,
Because it's split, if it's tenants in common and it's split differently, or even if it's joint but you've told the revenue it's split differently, it affects things like your will, your inheritance tax, capital gains tax,
of course,
all of those. So your legacy that you want to leave, it affects all of that.
yeah,
So get advice before you do it. It's not as simple as saying we want more income to that and more income, because it does affect other things.
yeah,
So get solicitors and accountants' advice is my
okay. So you
comment.
can absolutely save money by doing it, but just make sure you
There
understand all the kind of connotations.
There are connotations down the line.
Okay,
The other option you've got with ownership is limited company.
yes,
And the reason you do limited company is it's a lower tax rate.
mm-hmm.
One thing you should never ever do if you own a property already is transfer it to a limited company. Never do it. It costs you stamp duty,
Yeah,
it costs you capital gains tax, and it costs you capital gains tax when you actually get no money for the property.
yeah,
So you transfer the property, you've effectively sold it, you've got a big capital gains tax bill, but you've got no money because you haven't actually sold the property.
Yeah, exactly.
Never ever transfer it. Consider it when you're buying a new one.
Yeah.
Get advice, because again, running a limited company has connotations to having it by yourself.
Yeah, so another thing worth considering, but if you're looking at purchasing as a limited company, take advice.
Yeah. Limited companies often work best for people who are buying several.
Yeah.
Because you can time your income and stuff to affect your own tax rate.
Yeah.
Often for one per one, it's a bit overcomplicated for not a lot of savings, and you may find actually the cost of doing the limited company is more than you save in tax.
Yeah.
So not for everyone.
One to think about. Okay.
The second one I put down was make sure you keep a separate bank account.
Yes. Sounds obvious.
Now, it isn't, because I would say most of the ones I've dealt with have not kept a separate bank account. Now, obviously, keeping a separate bank account doesn't save you tax. What it does, it keeps all your records separate.
Yes.
So anything you spend on your property is recorded in that one bank account. All your income is recorded in that one bank account. You're far less likely to miss an expense that you could claim because it's there.
Yeah.
You also, of course, know how you're doing just by the fact you've either got money in your bank account or you haven't.
Yeah.
So you know whether the actual thing is working for you. When you come to fill in your tax return, it's much easier to do it if you've got a separate bank account.
Yeah.
If worse comes to worse and you get an inquiry from the revenue, there's your bank account.
Yeah.
They can look at it and prove everything that's on your statement. So definitely, and I recommend this for business and landlords, get a separate bank account.
Because there's not necessarily a fee attached to that either,
No.
so you can just set up a separate account with your current bank and just move all your rental related transactions into that account.
Yeah, it doesn't have to be a business account unless it's a limited company. So you normally get it for free.
Yeah.
So just do that.
Good tip. I'm surprised the number of people, I think it's true, that don't do that. I must admit, when I first became a landlord, probably the first year, I didn't keep a separate bank account, and I learned the hard way. So now I always keep a separate bank account, and that's not just for rental. I keep a separate bank account for each property because I like them very clearly defined, and it doesn't cost me anything.
That's a good idea. I keep a spreadsheet for different properties.
Oh, right. I bet you do. Okay, tip number 3.
Tip number 3, 2 claims that you can make that a lot of people miss. If you run a portfolio, you generally run that from home. Even if you use an agent, actually, you do all your stuff, you keep all your records and everything at home.
Yeah.
You can claim for using your home as an office. Okay. The claim is £4 a week at the moment. That's a statutory rate. You don't have to prove any expense for that. So that's £208 a year you claim as an expense.
So that's £208 tax free?
Yeah.
Excellent.
So I think I worked it out, that's £83 for a 40% taxpayer.
Yeah.
Just for writing a number on a form.
Absolutely worth doing.
Definitely worth doing.
Yeah.
The other one is to claim for use of your own car. If you use your car for visiting the property, visiting an agent about the property, going to the post office to post letters about the property, anything like that, you can claim a mileage expense for doing that.
And that includes if you nip to B&Q to buy some paint for the decorator or give it a fresh coat of paint yourself.
Yeah. So any trip that you make specifically to do with the property, you can claim a mileage allowance for. That rate is 45 pence a mile. So you do 100 miles, you can claim £45 worth of expenses. So claim it.
Yeah.
One thing you must do with that though is keep a record.
Yes.
You must keep a list of when you went, where you went, how many miles it was, and the reason why you made the journey. Yeah. So, for example, going to B&Q to buy paint. You
just need to click your mileage button thingy on your car and
record it down, and you've got a free claim.
Excellent.
So that saves some tax. And most people don't do that.
No, it's not something necessarily most people would think to do. So definitely one worth knowing.
Yeah. So what are we up to? Number 4? Number four is to make sure you claim expenses when your property is empty.
Okay.
Because I've come across it that people think they're not renting it out at the moment because they haven't got a tenant in there for some reason. They may be doing some work on it. You can claim the expenses that you incur during that time.
So council tax is a big one.
Council tax, insurance, obviously still the mortgage interest, although you can't claim mortgage interest. I'll come to that later. But any expense that you incur while the property is empty, provided you're still looking to tenant it, you can claim that. And make sure you do, because obviously it's costing you money to be untenanted. So get those in. Because I know people who said, "Oh, no one was in there for that month."
Does that include things like utility bills? If
Yes.
you've got the electricity, the plasterers in, and you've got the lights on?
All of that you can claim.
Excellent.
So basically, anything to do with that property, while it's not tenanted, claim it back. Make sure you claim it.
Brilliant.
And the last one came down to capital gains tax.
Yes.
Because this is a problem that I have come across.
And it's a big tax.
It's a big tax. So hopefully you want to pay capital gains tax because that means your property's gone up in value.
Yes.
So avoiding capital gains tax, or the way to avoid it, is to not make a profit, and that's not a good thing.
No.
So don't worry too much about capital gains tax or trying to avoid it, but try to minimise it.
Yes.
First thing, when you buy the property, keep all the records of what you paid for it. So that's the purchase price, the solicitor's bills, the valuation fees, anything to do with buying that property. You cannot claim that against income tax, but you can against capital gains tax. So people often forget when I come, well, how much did you buy it for? Oh, it was about 50,000. Well, how much exactly? I don't know, I don't remember. How much was the solicitor's fee? Oh, I don't know. And you end up either not putting it down, or you can go to a valuation service that you have to pay for to find out what that property was worth. That tends to overvalue or undervalue depending on what way the HMRC want it to look. So keep all of that as a record because it's all claimable against your capital gains tax, and make sure you do that. I forget what the second one was I put.
There are expenses that you can claim that you've spent money on the property against capital gains, can't you?
So if you make improvements to a property, now there's a distinction between what's called a revenue cost and a capital cost. Revenue costs are things like maintenance and general decorating and maybe putting a new kitchen in if there was one there before.
Right, so it's revenue because it's revenue generating, I suppose. If you're making your property nicer, more appealing to tenants, you're earning
but basically
from that.
Kind of replacing what's already there is revenue cost. Things like if you've got double glazing but it looks a bit rubbish, putting new double glazing in is a revenue cost. If you're putting a new kitchen in, it's a revenue cost if there was a kitchen or a serviceable kitchen there in the first place. If you're putting a new kitchen in and there wasn't a kitchen at all, that's an improvement. And that's a capital cost.
And would the same go for windows if you had maybe the old style, or if you bought a property that had single glazing and you wanted to upgrade to double glazing?
Double glazing has kind of its own rules. It used to be that single glazing replaced with double glazing was capital cost. You couldn't claim it as a revenue cost on your income tax. You can now, because double glazing is seen as the standard. You would never replace single glazing with single glazing. You just wouldn't. Well, unless you're in listed properties and that's all you can do or something. So it's seen as the industry standard that you would put double glazing in. So you're allowed to claim that. It's just, they expect you. They wouldn't expect you to put single glazing back in. If, for example, you knocked an internal wall down, made the kitchen much bigger, that's an improvement to the property. That's going to increase the value of the property because it's a much nicer, much more desirable place to live. That's capital. There are bits and pieces that are a bit mixed, and you kind of have to make a bit of a judgment sometimes. But if you're doing all that, if you put an extension on, for example, that's obviously capital. It's going to increase the value of your property. Keep records of all of that, all the cost, because all of that is claimable against capital gains tax. So make sure you've got a note of it. Keep a spreadsheet, whatever you do. Make sure, because it's all claimable.
There's just sensible avoidance of tax that you don't need to pay.
Because if you, and the other thing with capital gains tax is it's one of the areas that HMRC like to have a look at.
Yeah.
Because it's so well. First of all, it's so easy. Not easy. People don't always pay it. Don't claim it. That's not so easy, particularly with property now.
Yeah.
Because HMRC get informed when property is sold, and people put in costs that they can't prove. And if you can't prove it, HMRC will generally disallow it.
Yeah.
Then you've got a fine for misdeclaration, you've got more tax to pay, and it all goes wrong.
Yeah.
So keep a record.
Cover your back on that one.